I'm Caroline Woods, and this is your NYSE brief on yield curves. A reminder, briefs are for educational purposes only. The New York Stock Exchange does not recommend any investments or investment strategies. If you track the markets, you've probably heard of the yield curve. Maybe that it's steepening or flattening or possibly inverting. Traders often look at the yield curve for clues as to how the economy is performing and ultimately where interest rates are heading. But what is it? The yield curve is a line on a chart that shows the relationship between, among other things, short-term and long-term interest rates of U.S. Treasury notes. These are bonds issued by the U.S. government. When we talk about yield, we're referring to bond yields, or how much money your money is making. So you divide the coupon payment of a bond by the bond price. For example, if your bond is trading at $100 and pays a coupon of $5 a year, its yield is 5%. Shorter maturities are typically associated with lower yields, while longer maturities are typically associated with higher yields. To calculate the yield curve, simply plot a variety of bond maturity dates against their yields. In this case, we'll use 3-month, 2, 5, 10, and 30-year maturities. Once you do this, you end up with a curve. The shape of it is very important. There are 3 main shapes of yield curve: upward sloping or positive, flat, and downward sloping or inverted. A positive upward sloping curve starts with low yields for shorter term bonds and then increases for bonds with longer maturity. This is considered normal because longer term bonds typically pay investors higher interest rates. Think about it. A longer term bond ties your money up for a longer period of time, as many as 30 years. So you're going to expect a higher reward for taking on that risk. An upward sloping curve tends to imply stable economic growth. The steeper the curve, the stronger the economy. A strong economy could eventually lead to inflation, and in turn the Federal Reserve raising the Fed funds rate, which is closely tied to short-term interest rates. When short-term and long-term rates start getting closer together, it's called a flattening curve. So a 2-year, 10-year, and 30-year bond might all offer the same yield. This can happen when there's a lot of uncertainty in the market, or when the Federal Reserve is expected to hike rates. Sometimes the long-term rate dips below the short-term rate and the graph appears downward sloping. That's called an inverted yield curve. An inverted yield curve tends to happen when investors expect slower economic growth, and in turn for interest rates to fall. In times like these, investors look for safer investments, like longer-term bonds. Or they expect future rates to fall and want to secure current rates, so they bid up the price of longer bonds, which drives their yield lower. An inverted yield curve has historically been an accurate predictor of recessions, so it can cause concern among investors. Even a brief yield curve inversion can spook the markets, though it's typically a prolonged inversion that actually indicates a recession. That said, just because it's been an accurate leading indicator in the past doesn't guarantee future accuracy or performance.